Hello guys, welcome. So today we are going to see about AS 26, Accounting Standard 26, which talks about the intangible assets. So first we are going to see what is an intangible asset. So there are few intangible items which if certain characteristics are fulfilled, they turn into intangible assets. So first there are some intangible items. When these intangible items fulfill some characteristics, they turn into intangible asset. What are intangible items? Intangible items are items which are neither seen or not can be touched. Okay. So the first, totally you have 7 characteristics which if fulfilled turns into an intangible asset. So what are the 7 characteristics is what we are going to see. Okay, so the first characteristics is identifiable. So I'll give you an example for identifiable. Suppose there is this company called Airtel. Okay, there is this company called Airtel. The Airtel wants to expand its business area in Tamil Nadu, suppose. Okay, then it have to get permission from Tamil Nadu to expand its business or run its business in Tamil Nadu. Tamil Nadu government will issue a license to Airtel. Okay. So this license is an intangible asset. So intangible asset, if it needs to be identifiable, it needs to have a separate identity. It needs to have a separate identity. So how do you create this separate identity? Suppose Airtel has got its license and suppose this license is given to Airtel for 15 years. Okay, suppose this license is given to Airtel for 15 years. For the first 5 years, Airtel can use it, and if after that it doesn't need, then for the next 10 years, it can give it to someone else. Like it can rent it to someone else. So the license is an intangible asset, which is actually a separate entity. It can be separated from the entity itself. Okay, so separated from the company itself. So it is identifiable, meaning it has a separate identity to itself. Okay. Second one is without physical substance. Second one is without physical substance. Without physical substance means it does not have any physical form. So a good example for without physical substance would be example goodwill. Goodwill does not have any physical form to it. So, but there is an exception to it. There is an exception to it. What I have written here is exception. Sometimes it may be negligible. Example, now I am taking online classes. Suppose, and I have pen drive for my online classes. And I sell it at 15,000 rupees and I sell it at 15,000 rupees. So when I sell this pen drive for 15,000 rupees, the pen drive value is only either 400 to 500 only. But why do I charge 15,000 rupees? I charge 15,000 rupees not for the pen drive but for the content in it. Right, but for the content in it. This content is my intangible asset. But what I say here is, for this intangible asset to reach someone, I have to have the use of physical substance, which is a pen drive. But this pen drive is just very negligible. Okay, but the dominating factor here is only the intangible asset. So exceptions like these would also make it to the intangible assets. So it must be without physical substance like goodwill, but sometimes there are exceptions that it can be negligible. The physical substance can be negligible, like in this case. Third one is non-monetary asset. Non-monetary assets in simple terms would be assets which are not receivables or payables. Example, if it is creditors, means from where you have to receive amount, okay, then it is not a non-monetary asset. So example, you have debtors where you have to pay, so it is a payable. It will not come under non-monetary asset. Example, you have some loan which you have to take or give, which is either receivable or payable. That will also not make it a non-monetary asset. Non-monetary assets are assets which are neither receivables nor payables. Example, you can have land or building. This is what is non-monetary asset. Next, what you have is held for use. So next what you have is held for use and production or supply of goods or services. What is held for use and production or supply of goods or services? Held for use means not held for sale. Suppose, for example, you have some softwares and you run a business to sell these softwares. And you have a business where you sell these softwares. Software is an intangible asset. The software which you have held now is for sale. It is not for use in your own business. So this software would not be considered as an intangible asset. This software in your entity would be assumed as your inventory would be accounted as your inventory. So the software would not be as intangible asset, it would rather be as inventory. That is what is the difference between held for use and held for sale. Okay, held for use means which is not held for sale. So it is held for use in either production or supply of goods or services. I'll take an example for this. Example, for now I am providing you video classes, right? I am providing you video classes through YouTube. So when I am providing these video classes, I use a software. I use a software which is a video editing software, Okay, so the software is an intangible asset. I am using the software for supply of my services, okay. This video editing software is only held for use and not for sale. So this would make it to the intangible assets. So likewise, held for use in production or supply of goods and services, or for rental to others, or for administration purpose. Here I gave an example for rental to others. This 10 years license, you rent it to someone else. So that would also come in intangible assets. Okay. So first 4 points which I have explained about would tell you what are the characteristics of intangible asset. The next point what we are going to talk about is in our entity item. Suppose this is an intangible asset. Okay. In the eyes of everyone it is an intangible asset. But when it comes to my entity, when will I record this intangible as mine? When will I record it? Suppose I have an intangible asset, but if it does not fulfill these two conditions, I will not record it in my books as an intangible asset. So we are going to see what are the two conditions that are required to be fulfilled for an intangible asset to be recorded in my company's book, in my entity's book. So the fifth point. It says that future economic benefits should be expected to flow to the enterprise. That means if you have an intangible asset, with the use of such intangible assets in the future, some benefits should flow to your enterprise. Sixth one is controllability. So what does controllability talk about? Controllability means you have a control over it. With the control you have, you can restrict the right of others to use it. Example, you have your mobile phone, okay. Suppose if anyone touches it, it is your mobile. You can restrict someone from having access to your mobile. So that is a controllability you have upon your mobile, right? So that is a nice example for controllability. There is actually another condition which says the cost should be reliably measurable. The cost of the intangible asset should be at least reliably measurable. It must be not like that you are not even able to measure the cost of intangible asset. So the cost should be reliably measurable. So the first condition need to be fulfilled for intangible item to become into an intangible asset, and the next three conditions should be fulfilled for the intangible assets to be recorded in your books of accounts. Okay, so we have now seen what are the characteristics of intangible asset. Next, what I have done is AS26 I have divided it into 4 parts: initial recognition, subsequent expenditure, disposal, and amortization. In initial recognition, we learn how we are going to recognize the intangible asset, and in our books of accounts how we are going to recognize it. In subsequent expenditure, we learn if we make some expenditure after the initial intangible asset is either made or acquired, how will you record it? In disposal, we learn how you dispose the intangible asset and what are you going to do in books. What are the book treatment for it you are going to learn in disposal. In amortization, just like how tangible assets depreciate, same way intangible assets also depreciate, which is known as amortization. So this amortization, how are you going to treat it in your books is what we are going to study in amortization. So first we will start with initial recognition. So initial recognition, I have separated it into 2 parts. So first is recognition criteria, when you will recognize it in your books of accounts, that we have learnt already now. Okay. Second one is measurement. So measurement is a measurement. So in measurement you are going to learn how, you know now that you can record your intangible asset in your books of accounts, how are you going to record it, at what value are you going to record it. That is what we are going to learn in measurement. Okay. So how are you going to measure it? Initial recognition means first time in your books, how are you going to record it? So measurement, how are you going to measure it? So I have separated into two parts. One is self-generated intangible assets and the second one is acquired intangible asset. Self-generated intangible asset means those intangible assets which the entity have built by itself or generated by itself, means which the entity have generated on its own. Okay, acquired means the entity has purchased it from someone else. The intangible assets, they have purchased it from someone else. Okay, so first we are going to see self-generated. So self-generated, you have two types. You have one is goodwill, trademark and copyright, and then other intangible assets. So intangible assets under self-generated are classified into two parts. One is goodwill, trademark and copyright, and the other one is others, all other intangible assets. Okay, so how will you record goodwill, trademark and copyright which is self-generated by you in your entity? You will not recognize it at all. You will not recognize it in your books of accounts. So always remember, under self-generated, if you have self-generated goodwill or self-generated trademark or self-generated copyright, you will never recognize it in your books. Okay. Then what about other intangible asset? Other intangible assets, example, if you have some self-generated patent, means you have found a medicine and you have patented it, means that is something you have self-generated it in your company. Okay, patent or some know-how, you have developed some process. So other intangible assets, how are you going to record it in your books of accounts is what we are going to see first. Okay, that is the second topic. At what amount should the other intangible assets be recognized in the books of accounts? Okay, so first what we are going to do is other intangible assets, we are going to see expenditure on self-generated other intangible assets. We are going to split it into two parts. One is the research phase expenditure, second one is the development phase expenditure. I'll first tell you what is research phase and what is development phase. So research phase means phase during which knowledge is gained through planned methods. So what is research phase? I'll give you an example. I'm planning to start satellite classes. So first I have to research. Okay, I have to first research whether I can do my satellite classes. What are all the resources I will need? What are all the technology which will be involved in this? What cost structure would I have in this? How much cost would I incur if I have to take the satellite classes? All the research which goes on to making the satellite classes is what will happen in the research phase. So in every company you will have a R&D department. So research and development department would first, before they self-generate an intangible asset, first what will they do is they'll research about this intangible asset, whether it is feasible for them, whether they have the resources, where they have the technology. Where they do this is they'll do it in the research phase. They'll research about it. That is phase during which knowledge is gained. That means you gain knowledge about the intangible asset, what you are going to generate later. Okay. What is development phases? With the knowledge whatever you have gained in the research phase, you are going to apply it in the development phase and develop the intangible asset. That is what you are going to do in the development phase. That is application of such knowledge which is already obtained in the research stage. Okay. For an intangible asset to be in development stage, few points needs to be fulfilled. You will only consider that an intangible asset is in a development phase only when 4 conditions are fulfilled. What are those 4 conditions is what we are going to see now. So here I have written the conditions. If all of the following conditions are satisfied, then it is considered as development phase. An intangible asset should satisfy all the 4 conditions to be said to be in the development phase. So what are the 4 conditions? First condition is that whether the technical feasibility has been established. That means if you are thinking of taking up satellite classes, is it practically possible? You have to see, do you have all the technical feasibility, all the technical help and support to start this satellite classes is what you have to see. If yes, then see the second point. Management has approved its development. That means in AGM, the management has decided that you are going to use the knowledge which you have obtained in the research phase in the development phase. If this they have approved, whatever knowledge you have developed in research phase, you can use it in the development phase. Then once you get the approval from the management, you can consider it as a yes. Okay. Third one, market exists for intangible asset. In this, you have to check whether the satellite classes you are going to make will sell or not. Is there any market for this or not? If there is a market, good. Next, you have to move to the fourth point. Resources exist for intangible asset. That means for preparing this intangible asset, do you have these resources in India? If not, can you fetch it from outside is what you have to see. So you have to see the idea you have thought for intangible asset. Does India have such resources? You have to check. Example, for satellite classes, do you have the technology in India? If no, can you import it from outside India? You have to see. Okay. So these are the 4 conditions. If all the 4 conditions are fulfilled, the intangible asset is said to be in its development phase. Okay, so now that you have understood what is research phase and what is development phase, we'll see whatever expenditure you are going to incur in the research phase and development phase, how are you going to record it in your books of accounts. First, we'll see the expenditure which you have incurred in the research phase. If you have some expenses which you have incurred in the research phase for doing research, what will you do is you will transfer such expenses to P&L. You will transfer such expenses to P&L, and P&L debit you will put, because debit is for expenses, right? So in P&L debit you will put such expenses. Now you have done such expenses in development phase. So when you are developing the intangible asset, you have incurred some expenses. So how will you record this? So here you have 2 conditions. If those 2 conditions are fulfilled, you will capitalize it. Okay. If those conditions are not fulfilled, you will expense it. Expenses means put it in the P&L. Okay. So what are those 2 conditions? You have to see whether you have certainty about future economic benefits. That means whatever intangible asset you are developing, that intangible asset, would it give you benefits in the future? Would it give you economic benefits in the future? You have to see. Okay, if it is giving you economic benefits in the future, next point what you have to check is whether you are able to reliably measure the cost of the intangible asset. Okay, and the cost is reliably measurable. Yes, if the intangible asset is going to yield you economic benefits in the future, plus the cost is also reliably measurable, then what you have to do is you have to capitalize the expenses which are incurred in the development phase. What does capitalization mean? Example, if you have a machinery, okay, and you do installation expenses for the machinery to be installed in your entity, okay, or you have an AC. For the AC to be installed in your home, you incur some installation expenses. Okay. So this installation expenses, you will not put it in the P&L account. You will add it with the cost of the asset, right? You will add it with the cost of the asset. So likewise, if there is some intangible asset and if there is some expenses which you have incurred in development phase and those expenditure meet the 2 conditions of future economic benefits and cost, then you have to capitalize it, meaning you have to add it to the cost of asset. So capitalizing means adding to the cost of the asset. If suppose these 2 conditions are not fulfilled, whatever expenditure you have incurred in the development phase, you will transfer it to P&L. That is what I have written here. Research phase expenditure shall be expensed, meaning it should be transferred to the P&L. Development phase expenditure shall be capitalized. Capitalize means to add to the cost of the asset. If there is certainty, only when you will capitalize, if there is certainty about the future economic benefits and cost can be reliably measured. Otherwise, it should be expensed. Okay, so here there are 2 important points. What it says is, first point says that once expensed can't be capitalized again, meaning in year 1, year 2. Okay, so in year 1, what you have done is you thought that you will not receive any future economic benefits. You will not receive any future economic benefits. So what you do is the development phase expenditure, you transfer it to P&L. In year 2, you are very sure that you would get some future economic benefits from the intangible asset. So in future, you would get some future economic benefits from the intangible asset. So in this year, what you do is you capitalize the expense. Okay. So what the question here is, in year 2, when you got to know that it is going to give you future economic benefits in the later year, that means in year 1 you have estimated wrongly that it will not give you future economic benefits. So the question here is, can this amount which you have transferred in the P&L be capitalized now? The answer is no. You cannot capitalize once if it is expensed. The second point says is, once capitalized can be expensed, means in year 1, you think that there you will have future economic benefits, okay, in the future. So what you do is you capitalize such expense. In year 2, you get very sure that in future you will not get future economic benefits. Okay, you're very sure you will not get future economic benefits. So what you do is you put this expense in P&L account. Okay, so here the question is, in year 1, then you have estimated it wrongly that in future you will get future economic benefits, right? So whatever you have capitalized, can you now transfer it to P&L? The answer is yes, you can transfer it to P&L. Once expensed cannot be capitalized, but once capitalized it can be expensed again. So the next topic we are going to see is about the acquired intangible assets. So we have completed our self-generated assets. Now we are going to see the acquired intangible asset. You can either acquire it for cash or you can either acquire it for consideration other than cash. So acquired intangible asset. So when you acquire an intangible asset for cash, at what cost will you record it in your books of account? How will you derive at this cost is what we are going to see now. So what and all you will add to this cost is first the purchase price at which you have got the intangible asset, because acquired means you are purchasing the intangible asset from someone. So at whatever price you have purchased the intangible asset, that you have to include in the cost. Plus if there are any directly attributable expenses, that also you have to add. And these directly attributable expenses, until what stage will you add is till the asset is ready for generating benefits. Okay, so there is a stage. So first when you acquired this intangible asset, it wasn't ready to give you any benefits. Okay, then you incurred some expenditure and now it is ready to give you benefits in the future. So until this, whatever expenditure you have incurred, everything you have to add here. Okay. So purchase price and all directly attributable expenses till the asset is ready for generating benefits should be capitalized. That means added to the cost of the asset. Okay, so it must be capitalized. Okay, next we are going to see some examples for directly attributable example duties and taxes you might have paid, some documentation cost you have paid to acquire the asset, or some brokerage expenses which you have paid to acquire the asset. Everything would be included here. Okay, acquired for cash. We are done with this. Second part was if it is acquired for consideration other than cash. Consideration other than cash means barter exchange. Suppose this is your entity, you need some intangible assets. Suppose you need some patent. Okay, suppose you need some patent, you get it from another entity. This is your entity, you get it from another entity. In exchange of the patent, what you give to another entity is a machinery. So this is consideration other than cash. In this case, whatever patent you are receiving, at what cost or book value will you record this patent in the balance sheet? When you are recording the patent, at what value will you record this patent is what we are going to see now. So what they see is, you have to see the fair value of asset acquired. What asset have you acquired now? Patent. Okay, fair value of asset acquired is 100 rupees. Okay. Or what you have to see is fair value of the asset which is given up. What asset you have given up? Machinery you have given up, and the fair value of the asset is 500 rupees. So which you have to record is which is more clearly evident. Whichever value is more clearly evident, that you have to write here. Suppose you have more evidence that this 100 rupees of patent is correct, then you have to record patent for 100 rupees in your books. If suppose no, you have more evidence that the machinery value of 500 is correct, then you have to record the patent for 500 rupees in your balance sheet. So that is what they say here, acquired in exchange with other asset. What you have to do is face value of asset acquired or the face value of the asset given up, fair value, whichever is more clearly evident, you have to record it in your balance sheet. Okay. So this is about this topic. Next we'll move on to subsequent expenditure. Okay, so now we are going to see about subsequent expenditure. So what is subsequent expenditure? I'll first give you an example. Suppose you have a machinery. Suppose you have a machinery in your entity. This machinery, after a few years of running, it needs to be repaired. Okay, this machinery after few years of running needs to be repaired. Okay, so this repair expense is a subsequent expenditure. Okay, so this repair expense is a subsequent expenditure after the machinery is bought and installed. Okay, so such type of expenses, how will you record is what we are going to see. So such kind of subsequent expenditure is how you are going to record is what we are going to see. Suppose this repairs what you are going to do is going to give you more future economic benefit in the future than what you are earning now. That is, it is going to increase a future economic benefit than what you are earning now. Then you have to capitalize it. If the what repair you have done, it is going to maintain the same future economic benefit as you are earning now, then you need to expense it to P&L. If subsequent expenditure increases the future economic benefits, then it should be capitalized. If no, the subsequent expenditure incurred to maintain the future economic benefit, just maintain it, then it should be expensed. Okay. So the fourth, so we are done with initial recognition and subsequent measurement. So the third topic we are going to see now is the disposal. So what is disposal? Disposal means when you are going to dispose of your or sell your intangible asset. At that time, what will you do? So intangible assets, suppose in your books, your intangible asset is showing for 500 rupees. Suppose it is showing for 500 rupees. Suppose you have two vendors. Okay, one is ready to purchase it for 400. Okay, another one is ready to purchase it for 700. So this is your book value. This is your sale value. Okay, what you have to do is you have to do book value, sale value minus book value. So sale value minus book value means, so in your books asset is for 500, but they are only getting it for 400. That means you will have 100 rupees loss. Okay. Otherwise, if they are selling it, if they are ready to take the asset at 700 rupees, but your book value is only 500, but they are ready to take at 700 rupees, means you will have a profit of 200. So whether it is profit or loss, whatever it is, profit or loss, you have to charge it to the statement of P&L. You have to transfer it to P&L. So on disposal of intangible asset, the difference between net sale value and net book value should be recorded as gain or loss in the statement of P&L. Okay, so now we are done with the disposal part also. Last part is remaining, which is about the amortization. So now we are going to see about the amortization. So in amortization, I have classified the amortization into three methods: life and residual value. So what is amortization? As you have depreciation for tangible assets, the same way the intangible assets also depreciate, which is known as amortization. So the first one we are going to see is how are we going to amortize this intangible asset. So the method we are going to see. So what it says is the depreciable amount of the intangible asset shall be amortized over the useful life in a systematic manner. So I'll explain it one by one. Okay, so first what they say is depreciable amount. Okay, so I'm going to take an example of a tangible asset so you understand more easily. Suppose the machinery is worth 5 lakh. Okay, what they say is scrap value of this machinery comes to 1 lakh. Then what is your depreciable amount? Depreciable amount is 5 lakh minus 1 lakh. 4 lakh rupees you have to depreciate in the machinery. So whatever depreciable amount of intangible asset is there, you should amortize it. That means you should depreciate it over the useful life in a systematic manner. Over the useful life means if the machinery has a useful life of 10 years, then this 4 lakh is to be divided upon the 10 years. So every year you will depreciate 40,000 rupees from the machinery. Okay, so that is what is given here. Useful life in a systematic manner you have to amortize. Okay, so amortization will be made on SLM basis if the pattern of future economic benefits is not determinable. Suppose you have some patent. Okay, you are going to amortize this patent. Okay, the patent value is 1 lakh rupees. Okay, so you know that you are going to get some future economic benefits from the patent. But you don't know how much future economic benefit are you going to get it. Like you know that for 3 years there is a life of patent. 3 years is the useful life of patent. Suppose we'll take for example. So year 1, year 2, year 3. You know for 3 years you are going to get future economic benefits. But in 1 year how much you are going to get, in second year how much you are going to get, in third year how much you are going to get, that is not determinable. So the pattern in which you are going to get is not determinable. Okay, so at that time what you will do is you will do 1 lakh divided by 3, and whatever amount comes here, every year you will amortize this amount from the patent. Okay, So that is what is given. Amortization will be made on SLM basis if the pattern of future economic benefits is not available. If the future economic benefit is determinable, then depreciate in proportion of future economic benefits. Suppose now you know in first year how much you will get, in second year how much you will get, in third year how much you will get, how will you depreciate now? Suppose I think my future economic benefit in the first year will be 5 lakh, in second year will be 3 lakhs, sorry, in third year it will be 2 lakhs. So 5 lakhs, 3 lakhs and 2 lakhs. If my value of the asset is 4 lakhs, suppose my value of the asset is 4 lakh and its useful life is 3 years, then depreciation would be in proportion of these assets. That means this 4 lakhs, I will divide it in the ratio of 5:3:2. Okay, 5:3:2, I will divide the 4 lakh rupees. So year 1 I will depreciate this, year 2 I will depreciate this, year 3 I will depreciate. If I proportionate the 4 lakh rupees into 5:3:2, I will get 2 lakh, 1.2 lakh and 0.8 lakh. So in first year I will amortize 2 lakh rupees, in second year I will amortize 1.2 lakh rupees and in third year I will amortize 0.8 lakh rupees. So if future economic value is determinable, you will depreciate it in the proportion of the future economic benefit. Okay. So next topic is life. So we spoke about useful life here, right? So they have a condition for useful life. What they say is all the intangible assets shall not have a useful life more than 10 years unless otherwise justified. So I've given an example here. Suppose you estimate. Okay, so what is actually a useful life? Useful life is something that you estimate. You think that this machinery will work for 5 years. Okay, so you think this plant will work for 8 years. So its useful life is something estimated. Suppose you estimate the life of the intangible asset as 10 years, you can take the life as 10 years. If suppose you estimate the intangible life as 8 years, you can take it as 8 years. But if you estimate the intangible asset's life as 12 years, you only have to take it up to 10 years. Unless otherwise justified. Suppose if this 12 years of estimated life is justified, that means if you have a contract which says as 12 years, then you can take the life as more than 10 years, which is 12 years you can take. But for 12 years, if you don't have any contract or it is not justified why you have estimated it as 12 years, then you should only take it as 10 years. But if it is justified, this estimation is justified with the help of a contract or something, then you can take it as 12 years itself. I hope this is clear. Here one more point which you have to remember is, in case of the website and software is also an intangible asset. In this case, here for other intangible assets you can take up to 10 years. But here you can only take up to 3 to 5 years. And higher life you can take if it is justified. Okay. Next what we are going to see is the residual value. So residual value, I told you residual value is nothing but the scrap value of the asset. So residual value will be assumed as nil for intangible assets. So machinery, you keep some residual value and then calculate depreciation, but that is not how it is followed for intangible asset. For intangible asset, the scrap value or the residual value is considered to be nil. Unless otherwise justified or guaranteed. Okay. Suppose if there is a contract that they will buy your intangible asset at 20,000 rupees at the end of the useful life, then 20,000 rupees is your residual value. Okay, so 20,000 rupees is your residual value. If there is no such contract or guarantee exists, then you must keep your residual value as nil and calculate your amortization or depreciation. Okay, so this is the end of the 4 topics. There are just like little two things I have to say. First is, for clarification purpose, following are not intangible asset as per AS 26. And this, if they are not intangible asset, what you should do with them is, once you incur these expenses as per AS 26, if you incur these expenses, you should write it off to P&L immediately. As and when the same year you incur the expense, the same year you have to write it off to P&L. So the first such expense is preliminary expenses. Second is pre-operating expenses. Third is staff training cost. And fourth is heavy advertisement expenses or advertisement suspense account. Okay, whatever you call it. These 4 expenses, please remember these 4. Okay, it might be tested in exam. These 4 expenses you will not include as intangible assets. And these 4 expenses have to be written off to P&L immediately. So next is the disclosure requirements. So disclosure requirements, you have 3 disclosure requirements. So first is the disclosed along with assets. So intangible assets have to be disclosed where you disclose your assets. Okay. Balance sheet. Okay. Second one is intangible amortization policies should be disclosed. So what kind of policy are you following for amortization? That you have to SLM or whatever other method you are following, that you have to disclose. Third one is intangible asset acquired during the year should be disclosed. Suppose you already have some intangible assets in your balance sheet from past year, but this year you have only acquired intangible assets. Suppose you have acquired means you have purchased some intangible asset this year, then you have to show it as a disclosure. You have to write it in along with all intangible assets, but down you have to show a disclosure. Then this particular asset worth this much I have purchased or acquired this year. You have to disclose. So guys, that brings us to an end of intangible assets. I hope you would have found this video useful, and for some it will be coming soon. Thank you.